Hi, I'm Jennifer Alcabao, Director of ICCP Venture Partners, a trans-Pacific venture capital firm with offices in Silicon Valley and Manila. ICCP Venture Partners provides early to expansion stage funding to companies in high-growth industries in the US and Asia. What are the different ways of raising money for your startup? Raising capital for a startup business has never been easy. At the onset, most entrepreneurs try to build their business by bootstrapping, using personal income and savings, credit cards, or even mortgaging their home. Many of today's largest corporations like Apple, Dell, Hewlett-Packard, and Microsoft began as bootstrapped operations. So if you can no longer finance your business out of your own pocket, you will have to approach other people for funding. Investors are typically segmented by life cycle stage of the business. The type of investor you would attract would depend on your startup stage of development. It is typical for seed funding to come from people who know and love you, family, friends, and sometimes fools, the 3 Fs, or AKA love money. Naturally, these people would want to support you and help you succeed, and they are less likely to demand a high return on their investment. Friends and family investments are usually small and made in a very informal way and used for early validation, when you need to test assumptions with your actual target market and customers. You may also seek funding from government grants, business incubators, and startup accelerators like Ideaspace, Y Combinator, 500 Startups, and Launch Garage, who not only provide seed funding, which can be anywhere between $10,000 to $250,000 US, but also provides general business assistance, mentoring, and training to startup entrepreneurs. You may also seek funding from government grants, business incubators, and startup accelerators like Ideaspace, Y Combinator, 500 Startups, and Launch Garage, who not only provide seed funding, which can be anywhere between $10,000 to $250,000 US, but also provide general business assistance, mentoring, and training to startup entrepreneurs. Funding from these sources would normally get your business off the ground from a piece of paper to building and launching a minimum viable product or a working prototype in order to test for customer traction. You may also try to raise financing via crowdfunding, which has quickly become a viable early-stage funding source, especially in the US. So what is crowdfunding? Basically, it involves raising many small amounts of money from a large number of people, typically via the internet. Seed or early-stage ventures can obtain financing by selling small equity portions to micro armchair investors, and these are often without personal meetings or due diligence. Crowdfunding can also be rewards-based, wherein entrepreneurs pre-sell a product or service to launch a business concept without incurring debt or issuing equity. Startups like Pebble Smartwatch and Ubuntu Edge successfully raised funds of over $10 million each via international crowdfunding platforms, Kickstarter and Indiegogo, respectively. Once your startup has shown potential and demonstrated traction data, such as forward orders, sales, signups, web traffic, agreements, patents, you may already approach angel investors for funding. Angel investors are high net worth individuals that typically invest their own funds. There are also angel groups that syndicate many angels together into a single investment. Entrepreneurs and angel investors will normally meet over coffee or lunch, talk about assumptions and expansion plans, negotiate term sheets and valuation, then move to doing more thorough background checks and research. The investment size of angel investors like Kickstart, Hatched, Wireless Wings range from $100,000 to less than $500,000, typically for 20% equity. Capital from angels fills the gap in startup financing between friends and family and venture capital. As most startups make mistakes and tweak strategies, which all impact expenses, angel investment should offer sufficient financial runway. When the startup gains meaningful traction, such as increasing revenues, pipeline, website traffic, user signups, and engagement, or some other metric, it may already seek expansion funds from venture capital investors or VCs, like ICCP Venture Partners. VC investment is the first round of institutional money to fund the company's growth. Unlike angels who invest their own money, VCs manage the pooled money of others in a professionally managed fund. VCs typically have to do a lot more due diligence than angels because they have a fiduciary duty to their investors. VC firms also differ in their approaches. There are VCs who invest in earlier stage companies that have some proof of execution even without traction, while others prefer to invest in established companies. Some VCs are focused on investing in specific industries, while others have a diverse portfolio. So, when you are approaching the VC community, make sure you have thoroughly researched not only their stage of business focus, but their industry focus as well. VC investment range from as low as $1 million to as high as $50 million, depending on the stage of the company's development and funding requirement. VCs support the companies not only by providing funding, but by providing strategic guidance and expertise. VCs typically have a 3 to 5 year investment horizon and target high returns, normally between 20 to 35% via liquidity events like a trade sale or IPO. Your startup could end up to be in the ranks of Facebook, Oracle, Google, Amazon, some of the most successful VC-backed companies to date. What are the pros and cons between raising funds through debt or equity? Deciding between equity financing and taking on a loan could be a challenge for anyone raising capital. To help you determine which type of financing is best for your business, let me walk you through the advantages and disadvantages of each. Equity financing is the most common source of financing for early-stage companies who have no or unpredictable source of revenues. It may seem very appealing to have an investor write you a check because it feels like you're getting free money. There are usually no repayment obligations and no interest payments due to equity investors. However, it also comes with huge strings attached. So let's go back to the advantages of equity financing. One, it's less risky than a loan because you don't have to pay it back, and it's a good option, especially for early-stage companies where cash flow is difficult to predict. You tap into the investor's network. Number two, you tap into the investor's network, which may add more credibility to your business. Number three, investors take a long-term view and most don't expect a return on their investment immediately. Another thing is that you won't have to channel profits into loan repayment, especially if you still do not have a recurring source of income. You'll also have more cash on hand for expanding the business, and there's no requirement to pay back the investment if the business fails. Another thing is that it gives certainty of valuation for your company, which can also be a disadvantage if the value is too low for diluting founder stake or too high, which can impact interest from next round investors. What are the disadvantages of equity financing? Number one, it's higher cost than debt. Since the investor is taking more risk, it may require returns that could be more than the rate you would pay for a bank loan. The investor will require some ownership of your company and the percentage of the profits. You may not want to give up this kind of control. You will have to consult with investors before making big or even routine decisions, and you may disagree with your investors. In the case of irreconcilable differences with investors, you may need to cash in your portion of the business and allow the investors to run the company without you, or vice versa. It takes time and effort to find the right investors for your company, more complex to structure, with the highest legal bills and the longest time to close. The business relationship with a bank that loans you money is very different from capital that you receive from an investor. It requires no need to give up a part of your company. But if you take on too much debt, it's a move that can stifle growth. So the bank or lending institution has no say in the way you run your company. That's an advantage, and it does not have any ownership interest in your business. The business relationship ends once the money is paid back. The interest on the loan is also tax deductible. Loans can be short-term or long-term. Principal and interest are known figures. You can plan a budget provided that you don't take a variable rate loan. So what are the disadvantages to debt financing? Number one, the money must be paid back within a fixed amount of time. And if you rely too much on debt and have cash flow problems, you will have trouble paying the loan back. If you carry too much debt, you will be seen as a high risk by potential investors, which will limit your ability to raise capital via equity financing in the future. Debt financing can also leave the business vulnerable during hard times when sales take a dip. And it can make it difficult for a business to grow because of the high cost of repaying the loan. Another disadvantage is that the assets of the business can be held as collateral to the lender, and the owner of the company is often required to personally guarantee repayment of the loan. Startups may also choose to issue hybrid or convertible debt for situations where you do not want to set an equity valuation so as not to impede subsequent financings from other investors, or you simply want the option of potentially paying back the cash for a period of time prior to taking in permanent equity capital. A convertible note is the way to go. A convertible note is a hybrid, part debt and part equity, where it functions as a debt until some point in the future when the principal and accrued interest may convert to equity at some predefined terms. Convertible debt is typically secured from the same angel investors and venture capitalists that fund equity deals and is usually used for smaller rounds of financing at the early stages of a company's life. What makes a startup attractive for potential investor funding? Angel investors and venture capital firms invest in a wide variety of industries. For example, technology, digital media, retail, healthcare, life sciences, and manufacturing. So before reaching out to any investors, make sure your industry is clearly in their sweet spot and skill set. VCs like us typically only invest in 1 or 2% of the deals that we see based on the following criteria. 1. Does your product or service solve a problem or a need? Is it different or unique or difficult to copy? Are you the first mover in your market or entering a highly competitive space? Is your technology patentable or not? Is the market large enough? Does it address a mass market or a niche market? Are you serving a $1 billion market or a $100 million market? Do you have proof of concept? Has there been proof of concept with revenues or site traffic to date? Is your business easily and cheaply scalable, or does it have heavy capital expenditures along the way? Do you have one-time revenues or a recurring revenue model? As a rule, capital-intensive businesses that heavily invest in real estate, inventory, or other capital risk are materially less desirable than simply technology businesses. The reason for this investor bias is the extra levels of risk that get added to your startup. Business startup risk is bad enough, with only 1 in 10 startups succeeding. But when you add on the capital expenditures, long-term leases, or merchandising inventory risks, it becomes a much bigger pill for the startup investors to swallow unless they have deep expertise in that space. Number 6, management execution. Are you a first-time CEO or an established veteran? How deep is the management team? We normally look at companies with experienced management team members and can steer the company through every stage of the company's development. We like management teams that demonstrate high levels of leadership skills and a high level of personal and professional integrity and like-mindedness with investors. We also look at companies that provide attractive IRR commensurate to the deal-specific risks. Is your IRR going to be a 10 times return or a 3 times return? So the more attractive the IRR is, the more attractive the investors will be to your startup company. We look at companies that have likely acquirers for the business, and in the industries where M&A activity is vibrant. We also like businesses that offer attractive potential returns commensurate to deal-specific risks. We look at whether the IRR is going to be a 10 times return or a 3 times return. So the higher the returns are, the more likely we will be attracted to a startup company. We also look at whether the startup has a defined and likely exit strategy. Since our investment horizon is between 3 to 5 years, we try to see if there are likely acquirers for the business and if the M&A activity in the industry is vibrant. What is an advisable way to allocate funds in the process of getting your startup out the door and scaling it? Raising funds or capital is hard work. The capital raise always distracts entrepreneurs from doing the actual work of building product and getting in contact with customers. Entrepreneurs should try to extend their cash runway and put off their capital raise as long as possible so that they can build value and get a higher valuation for their company before raising capital and diluting their equity. This is the same frame of mind that a budding startup needs to adopt. You have to stick to the bare bones and cut everything that is not vital to your business operations. It would be best for startups to keep the team as lean as possible and be mindful of all their expenses, be resourceful, purchase value for money. It doesn't have to be a top-of-the-line equipment, but it has to work. You have to develop your product, validate and test, and get it out of the market as soon as possible. My main takeaway is it is very critical to be capital conscious, particularly during the very early stages of a company's life. Because within what we feel like an incredibly short, stressful period of time, the startup needs to build product, figure out the market, and get some initial traction. Every month of cash burn is valuable. I hope you learned something from this module.